Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Welcome to Accredited Investor Markets Radio. I am your host, Christopher Cahill. This is episode number 7. In a bit, I'll be interviewing David Manshoory regarding his company's platform for investing in real estate debt. But first, a few notes from recent relevant writings. Shark Tank, the television program. I've never watched it, but I can say that John Greathouse wrote a critique of it worth reading in the Wall Street Journal on September 17. His point was that investors in startups are not properly analogized to alpha marine predators. Away from the TV studios, investors in startups are really more partners than they are predators. Also, Greathouse notes that big ideas and pitches may get the conversation started, but entrepreneurs must also show execution. One just considers how seed rounds work. First, there's some performance. Then, the entrepreneur can sell, usually less than 25% of himself or herself, her company, to seed round investors. Not giant chunks of equity flesh being bitten off by sharks after the presentation of big ideas. The Greathouse points, to me, coincide with an article posted recently on AIMkts.com by Jonathan Friedland. The article's title is Lessons on Investing Like an Angel, and you can find this on that website. He gives a series of lessons. Lesson 4 is treat people well. Not a very sharky lesson. I should also mention Jonathan Friedland's very recent Kindle book, The Investor's Guide to Alternative Assets, The Jobs Act, Accredited Investing, and You. I read the book. It's concise, clear, and helpful. It really does cut down on the unknown unknowns the reader will have with respect to alternative investments. So, Shark Tank is good TV, I'm sure. Probably. I don't know. I've never watched it, but let's assume that it's good TV. Consider that good TV, good theater, good movies, all of these media mix the real and the unreal. They mix facts and fiction. They miss the genuine and the false. Now, podcasting, that is straight up. So let us get to the conversation with our guest. Our guest this week is David Manshoory, the founder of AssetAvenue. David, please tell us who you are and what AssetAvenue is.
Sure, Chris. I'm the founder and CEO of AssetAvenue. We're an online marketplace for investors to invest in commercial real estate debt opportunities. What that basically means is that our investors and our members of our community have the ability to register, be a part of our investor community, and participate in investments with as little as $5,000 on their first investment and earn returns anywhere from 7 to 9% per year on fixed income debt investments that are backed by commercial real estate. And my background is I've been in commercial real estate for over a decade. I've worked at some of the largest real estate investment firms across the country, including Westfield Shopping Center, where I was underwriting $50 to $250 million real estate projects. And I've also had my own real estate fund before where I syndicated my own deals. And now we're merging technology and real estate together to allow more investors to access and participate in real estate investments through our online platform.
Excellent. All right, so focusing on accredited investors, what sorts of real estate investment opportunities exist now, and in what forms do they exist that were not there 10 years ago?
Sure. So 10 years ago, before people really even considered this idea of people investing online, everything was really done offline. So as an investor, if you wanted to access real estate investment opportunities, you had two options really. Either you had a lot of capital and the ability to purchase your own real estate, and you did that on your own, and you'd go through the tedious process of, trying to select investment opportunities from brokers, and many times a lot of investors have the capital to invest, but They don't know how to tell the difference between a good and a bad deal. And generally speaking, real estate can be very capital intensive if you try to do it on your own. And if you try to go to somebody who's raising capital and seeks investors to invest with them in a deal, many of those people would require a minimum investment of anywhere from $100,000 up to even $1 million per investor to participate with them in an investment. And so 10 years ago, even though a lot of accredited investors want to invest in real estate, there are a lot of hurdles and challenges. They needed a lot of capital. They needed to know the right people to try to get in on the deals. They usually are only accessing investment opportunities that are local or regional to them based on their local or regional network of real estate people that they know. And another challenge also is that a lot of people have the capital to invest in real estate, but they don't have the time or the wherewithal to determine which deals are good and which deals are bad. So that's 10 years ago. Lots of challenges. A lot of people made a lot of mistakes investing in bad real estate deals or putting too many eggs in one basket because they were forced to come down with a big investment in a deal, so on and so forth. Today is very different from 10 years ago in terms of how investors can now participate in real estate investment opportunities. The entire experience of investing, which has been done offline traditionally for the last 7 or 8 decades, has really become an online experience. And with the online experience have come a number of really large benefits to investors. So today, any investor can sign up on AssetAvenue, as an example, and they can view investment opportunities that a team of real estate professionals from AssetAvenue have pre-screened and pre-vetted. And with as little as $5,000, they can participate in any one of our real estate investment opportunities. And the minimum does a number of really key things for investors. A, $5,000 is really easy for accredited investors to invest. The reason the $5,000 is there is because we don't want our investors to invest one time. We want them to invest 10 or 20 times. And $5,000 is a really low-cost barrier to entry for an investor to say, hey, you know what? I want to try investing in this deal on AssetAvenue to get a taste of what it's like to start making a return through an online platform. And it allows them to see how the experience is new and different. The $5,000 also financially benefits investors because with a really low minimum, they can take the same amount of capital and they can spread it across a number of investment opportunities that are differentiated by geography and by returns and by holding period on the investment. And it allows them to just spread their risk and diversify. And so that allows investors to access a lot of deals that they haven't been able to before. And because our team of professionals pre-vet and pre-screen the deals, we're spoon-feeding to investors a higher quality, higher caliber pool of investment opportunities where they can have more confidence in where they're placing their capital.
Let me ask you about that, the aggregating and the analyzing that a platform manager, not necessarily AssetAvenue, but including AssetAvenue, would do. Private equity has come under some criticism in their private placement memoranda that they produce. And that criticism takes the form of criticizing private equity over hidden fees, obscure fees that mount. And in a very large investment, it might be noticeable, but would be even less noticeable in these small $5,000 increments. Are those kinds of things present in real estate debt private placement memoranda?
No. Two things. Equity is very different than debt. They're both investing in the they're both an investment in real estate, but because they're in different parts of the capital stack, they have different characteristics, right? So if you're investing in a syndicate where you're a limited partner in an equity deal,
yes,
there are a lot more complications and there's a lot more you have to look out for as an investor in the deal. Because there are a lot of things that are present in an equity deal that you don't have to deal with in a debt deal, which is one of the big reasons that AssetAvenue only focuses on debt investment opportunities. They're just much easier for investors to understand and participate in. So let's go back to your question, which is, in an equity deal where there's a limited partner and then there's a managing partner or a general partner, A lot of the revenue streams and income streams to the general partner can be challenging to understand because they create a lot of waterfall structures where, based on different return thresholds that they hit, it triggers a different split on the income between the investors and the sponsor and the managing partner. And so it's very hard up front for an investor to really understand how much is the sponsor going to walk away with and how much am I going to walk away with, and was that fair at the end of the day? And generally, especially at private equity firms, there are a lot of baked-in fees because generally private equity groups have investors that they have to give returns back to as well. And so they've got different parameters on how much they need to make in order to even survive and thrive as a private equity group. Online platforms in general change a lot of that because everything is being done online and investors expect a lot of transparency in the fees and the splits and in understanding how much the platform is making, and in an equity deal how much the sponsor is making. Again, on debt, it's very different, a lot simpler, less moving parts, and so that's why we're so bullish on debt from a transparency standpoint as well.
Well, all right. Let's say that an accredited investor wants to, for a number of the reasons you've been outlining, invest in real estate debt, but the investor fears the potential for a new bubble. There are many voices out there, and some are talking about a new real estate bubble. What sorts of factors should such an accredited investor take into account when investing in real estate debt if one is a little bit leery of inflated asset values?
Perfect. So let's talk about that because you just brought up probably the biggest benefit of investing in debt is your downside protection if the market slows down or corrects. So if you're an investor and you want to invest in real estate, and a lot of this stuff might sound basic, but I'm going to say it high level anyways because it paints the picture so clearly. If you have $1 million property, let's just use easy numbers, and it's a commercial property, usually there's a $700,000 mortgage, and somebody owns that mortgage and is getting paid on that mortgage, and it's usually a bank. And then you also have the opportunity to invest in the equity, which is the $300,000 down payment. A lot of people think of real estate investing as equity investing, and they ignore the debt side, or they don't realize it, and the opportunities haven't been as available as they will be now online. So what happens is if you invest in the $300,000 down payment, you're a part owner in the property. And there's a beautiful thing about equity investing, which is that if and when the market appreciates and does well, the property value appreciates. And so if the property goes from $1 million in value to $1.1 million in value, the equity investors just made $100,000 in equity, right? But the debt holder of the $700,000 mortgage, the loan balance doesn't get impacted by the market value of the property, right, if the property appreciates. But what happens in equity, the downside to it is that if the market slows down or corrects and that $1 million property is now worth $900,000, the equity holders just lost $100,000 of their initial investment. And the debt holder on the $700,000 mortgage is still safe and untouched. There's still a $700,000 mortgage on a $900,000 property, and the property owner, who's the equity holder, has to pay the mortgage payment every single month. Otherwise, they're going to risk losing the asset to the mortgage holder, who can pursue foreclosure proceedings and take back the asset from them, just like a bank. And so, financially speaking, debt is a lower risk investment than equity on any single property. The equity holders have the benefit of appreciation, but also are in a first loss position. Debt holders are in a last loss position. And debt is a fixed income investment. And usually, also, this is really important, equity is usually a longer term hold. You're looking at 3, 5, 7, sometimes 10-year holds. In debt, whenever you're investing in a loan, you know exactly what the term of the loan is for the borrower. And usually on AssetAvenue, our investment opportunities are anywhere from 1 year to 5 years. So you're looking at much shorter term holding periods than in an equity state. Now, I also agree that things might slow down in the market, and that's why we don't feel comfortable putting our investors in an equity position on any piece of property right now. We sway towards safety. We'd rather clip really high-yielding income on note opportunities then bet on the market to continue to appreciate the way it has been for the last 4 or 5 years.
All right. Well, let me ask you a mechanical question. So if a bank holds a mortgage, a senior mortgage, that bank decides when and if to pull the trigger on foreclosure if the borrower runs into difficulty making payments. Now, if you have a $5,000 piece of a $1 million, well, let's stay with the example you gave, of a $700,000 mortgage, well, you're only 1/40th of the entire debt holders. Who is making the decision when to foreclose?
Sure.
With whom does the borrower negotiate if there's going to be a modification, for example?
Sure. So if I really dumb down what AssetAvenue's goal is, AssetAvenue's goal is to every single month make a deposit in each of our investors' bank accounts for interest that they've earned on their money. It's to make our investors money and nothing else. And our investors are passive investors. They are not professional real estate. Let's just say their full-time job is not to be a real estate professional, and it's our job as a company, as AssetAvenue, to be the decision maker, since we have the most information on any one of our loans, to tackle any sort of foreclosure proceedings that we want to pursue on any note. And our investors look to us to be the professional to make those decisions.
So you're sort of like the indenture trustee in a bond structure.
Sure. Think of us as the managing partner who makes all the decisions to the benefit of all of our investors.
Okay, great. All right, so you're taking on significant duty there, and you've taken on a significant duty on the front end. That is to say, there are many platforms, or at least several platforms, connecting accredited investors with real estate debt deals. Each such platform has to select which deals, and that's different from platform to platform. There's competition among platforms. So an accredited investor trying to choose which platform to maybe trust or which platform to invest in today, it might invest in multiple platforms. How should the accredited investor look at how a platform selects which real estate deals to present? What are the meaningful distinctions on the selection principles?
Sure. So I'm going to talk about a few things to address this. Number one, AssetAvenue's management team is led by real estate professionals. I came from a real estate background. The team that I've recruited have all come from some of the largest real estate companies in the country, And so at our core, we're less of a technology company. We're more of a real estate and financial company. That's our strongest suit. And so we believe that the success of the platform is less about, the technology and the ease and so on and so forth. At the end of the day, quality in the deals is what's going to drive growth in our company. And investors are going to come back for more because they're making great returns that are great risk-adjusted returns. And so, as an example, our president of real estate is notorious and is famous for coming from Colony Capital, which is one of the largest real estate groups in the country, if not in the world. And his job between 2008 and 2010 at Colony Capital was to underwrite thousands of loans that were coming from the FDIC. They were all troubled pools of loans from the FDIC that were backed by commercial real estate across the country. And he led a really large team on behalf of Colony Capital where they successfully bid on thousands of loans to determine how much they're worth and if they're a good investment opportunity. He's brought over that institutional quality of underwriting to AssetAvenue to ensure that every deal we put on our site is a deal that we believe in. And many of our own employees and family members and friends invest in our deals. That's how much confidence we have in the product we put in our platform. And so our screening process is very diligent. We have a real estate committee where it's got to be a unanimous vote on every single deal that we put on the platform. And so there's a lot of confidence on our end, and only time will tell through the performance of those assets which platforms have done the best. If you take a look at the debt opportunities that we have on our platform, as of right now, all of the deals that we've done have been below 50% loan to value as an investment opportunity, which means that our loans the balance of the loan is less than half of the value of the property, which is a great thing because that means that there's a lot of downside protection, again, for our investors in case there's a market correction. And these deals are clipping anywhere from 8 to 9% per year for our investors. So on a risk-adjusted basis, there's much less risk that our investors are taking for an 8 or 9% return than they might be getting for an equity deal somewhere else at maybe a 10 or 11%.
Okay, well, you've given us some factors indirectly there to consider when deciding, which team to trust, so to speak, although that might be overstating it, but which set of recommendations to follow, which selection principles are more reliable. But let me ask you this. One thing you have not mentioned, and this is real estate we're talking about, is a regional focus. Do you think there might be an advantage to a company that adopts a regional focus for real estate debt investing, and that is a company that puts out a platform of different deals, just through familiarity with that regional sector?
I think being a regional platform is actually a detriment to investors. Yesterday, as an example, I was talking to an investor out of Houston, an accredited investor. Family is heavily invested in real estate in Houston and Austin, and they really want to start spreading their money around geographically, so they're not so heavily focused in 2 markets in one state. They really want to start spreading their money around to other, primary and secondary markets across the country. So I think it would be limiting to our investors if we focused only regionally. And I'm actually going to answer something that you mentioned earlier, which I forgot to because there was a lot to answer there, is how we screen the deals, right?
Yes.
So if you take what we do on our platform is, because we're a debt platform, we only look at investment opportunities where the loan balances are anywhere from $100,000 up to $10 million, and they're backed by investment properties. So that includes non-owner occupied residential properties, as well as all the usual suspects in commercial real estate. So office buildings, retail shopping centers, apartment buildings, hospitality, which is like motels and hotels, as well as industrial properties and mixed-use properties. And then we only focus on primary and secondary markets, and we only take into consideration senior secured mortgages, so they have to be the first mortgage on the property. So we have basically the lowest risk again. That's the logic behind being in a senior secured state. And we only look at loans that are up to 70% loan to value. We won't go north of 70% loan to value. And there are a number of factors. I'm giving you really high level what we're looking at by way of geography, the property, the loan term, the borrower, their credit score, the strength of the guarantee, and the strength of the cash flows from the tenants on the property. Those are the high level things we're looking at. And we've built a model that actually looks at thousands of data points for any single piece of property based on all those buckets. So these are really detailed deep dives where we look at every single, we don't leave a single stone unturned before we decide to put an investment on our platform.
All right, and how many investments do you have on your platform at this time?
So our company started in December. We're a team of about 15, and we did our first deal about 3 months ago to a private group of investors to test the platform. And about a month and a half ago, we opened up our deals. We are on our 3rd deal now and about to open our 4th. And I'll give you an example of a deal that we've funded. Our first deal was a $485,000 note that was collateralized by a commercial piece of property in Trump Tower in New York City in the Upper East Side. And the property was worth over $1 million. And the note was clipping 9% per year net to our investors, and there was about 4.5 years left on the note. And so investors got to get in on a loan opportunity that was below 50% loan to value with a really high income, fixed income debt opportunity. And we ended up funding that deal in 48 hours with investors as low as $10,000 and an investor that was as high as $150,000. So we're really excited about the platform and the investments that we're providing. And again, our protocol here is safety of capital first, and not projecting lofty cash on cash returns that we think we're seeing a lot, like you said, on the equity side, and such a frothy market where there might be some uncertainty in terms of how long the market's going to continue at the pace it is right now.
All right, and your intent is to seek deals and provide deals nationally?
Yeah, we're looking at geographically, and in the states and the markets where we feel are the most beneficial for our investors and our capital to be in. Again, primary and secondary markets.
Well, thank you, David Manshoory. That was very informative. You have been listening to Accredited Investor Markets Radio, a weekly podcast devoted to educating investors about the basics of investing in alternative assets. We hope you tune in next time.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.